So let me just go through very briefly. What I would like to bring you through in the next 25 minutes is firstly, some of the shorter term, longer term implications that we see from COVID, the impact of COVID on FinTech and SMEs. And then lastly, I would like to provide a bit more information about Abu Dhabi and Abu Dhabi Global Market and what we have done to nurture, to develop the entire FinTech ecosystem here in Middle East, North Africa region. Okay, right.
Okay, here we are. Okay.
So I think you can go to the third slide. So this is the content of today, but I think we can move on to the next one. So FinTech is a health crisis that resulted in a huge supply chain disruption because the first wave hit China, hit Asia. And given the plants lockdown and given how important China is in the entire supply chain globally, be it in terms of final products or in terms of intermediate goods, we saw that global trade and finance was hugely impacted in the first instance. And as the virus spread throughout the world, we saw a huge demand shock as various economies go through a lockdown situation, right? So demand just fell through the cliff on many fronts. We saw mass unemployment, especially in areas such as hospitality, such as restaurant, etc., etc. Even for those that have not experienced mass unemployment, you do see a drop in terms of disposable income as companies try to preserve cash. Given that revenue is impacted, people are looking at how to manage their costs going forward. So, or if not for emergency measures that various government has put in place, the pain will be much sharper because in the first instance, we saw a huge liquidity pain and liquidity crisis coming through. And that translated into market sharp fall, market crisis, and subsequently a credit crisis, given that non-performing loans will creep up. So as I mentioned, if not for the fact that government has come in with very decisive measures on various fronts to try to rescue economies, to try to pump liquidity into the ecosystem, we would have been much worse off. It has translated into a humanitarian crisis in many parts of the world, especially in the lower income developing world. Even in developed world, towards the lower income group, those that are living near poverty line, it has proven to be a very tough crisis, right? Because once you lose your job, once you can't generate income for the family, you are very, very worse off. And research has shown that this crisis hit those people that are earning less, much more than those that are earning more. We saw that economies enter lockdown situation much faster than they're able to exit the lockdown situation, right? So those that have imposed a lockdown, in terms of exiting, there are various dimensions at play: political, social, economical, as well as scientific. Depending on which dimension take precedence, different economies exit the lockdown in different ways, right? Some that has done a very good job, for example, like China, South Korea. Others are trying to have premature exit from the lockdown situation, where transmission is still quite widespread within the population. And even with those economies that have seen very good exit from the lockdown, we do see resurgence of COVID crisis. Can I move to the next slide? So the longer term impact are such, we are going to see quite a fair bit of macro trends that we already see prior to the crisis being exacerbated, right? Being accelerated. One of the trends that you're going to see, and which you're already seeing, is global governments need to raise the level of spending. There's going to be much higher level of indebtedness globally. Why is that the case? Even after all this emergency spending that's been put in place to rescue economy, society, and businesses, government is likely to need to spend much more going forward to make sure that economies, firstly, don't go through a deflationary scenario, right? To make sure that there's continue to be inflation. Secondly, government discovered that there have been many areas where it has been underspent in the past. For example, in the areas of healthcare in most developed countries. So governments are under political pressure to spend more into those areas. Thirdly, is the fourth bullet point here. Government realized the vulnerabilities in terms of supply chain, and given the global shock to the system, they are looking to bring supply chain closer back home. Right? They are going to promote local champions. This could be done in several ways. They are trying to secure food security, information technology security, critical manufacturing, health supplies, right? So countries such as China, such as Korea, that are able to manufacture your own face masks, test kits, ventilators, have emerged much faster and much stronger. So it's a lesson for all. Pharmaceutical, they're trying to secure financial services, energy, and the likes. So you're going to see a lot more spending by government. You're going to see, and that has to be funded in some ways or another through higher taxation, be it in terms of wealth tax, be it in terms of value-added tax, or taxation on industry that has done very well going forward, or will do very well going forward, such as technology companies. Another area that you're going to see is a much greater level of protectionism. This is a trend that we saw before the crisis, and unfortunately, my view is that this will get worse as a result of this crisis. Right? And crisis of this nature has a tendency to result in greater xenophobia. In the first wave, because it hit Asia first, the Western media portrayed this as an Asian disease, sick man disease, right? In that sense. Now you have different governments from a political dimension asking for damages, which in my view is quite absurd and a very novel concept at that. Because if you study the history, the 2008 global financial crisis originate from US, right? It caused huge pain throughout the world. It caused huge unemployment throughout the world. Financial capital was impacted. H1N1, another pandemic, again originate from the US, right? But there are no call for damages then. So I find this a very novel and absurd concept, but it's driven by politics. So we're going to see a lot more protectionism going forward. We are going to see, in the past 12 years after the global financial crisis, we saw a very positive credit cycle globally, right? Loan growth, very healthy credit cycle. Unfortunately, we are going into a negative credit cycle going forward. So non-performing loans will creep up. Right? But another key trend is much greater digital adoption all around. So this is a key trend that will be driven quite rapidly going forward. So if I can have the next slide. So the virus has really impacted the way we work, we consume, we interact. Today we are having this video conferences because of COVID-19, right? So it will permanently or temporarily change different behaviors and consumer patterns. If you take grocery shopping, right? China has a different situation because your supply chain is so developed, your local logistics is so developed, most of you shop online. But globally, that's not the case, right? So if you take grocery shopping, prior to the crisis, about 12% of global grocery shopping is conducted online. But because of the lockdown situation, people are forced to download apps, shop online, and now they are used to that convenience. They know how to do it. Post-COVID, you're likely to see, by some estimate, grocery shopping, more than 30% is going to be conducted online. So you can see all these changes. E-learning has become a trend, very much like this, what we are doing now. E-gaming, in-house entertainment, because sports events have been cancelled, esports have taken on new popularity. Right? So you have all these changes taking place. There's a preference of clicks over bricks going forward. Our work arrangement will be changed. Right? It has been impacted. We are all harnessing on cloud, harnessing on video conferencing, remote working. The concept of office is very different. We do have people that refuse to come back to office after the episode. You have some American enterprises such as Twitter saying that, workers can continue to work from home forever if they want to. But that has implications. In India, some of the largest outsourcing firms are going on a 25 by 25 movement. What does that mean? By the year 2025, only 25% of the workforce will be in the office. 75% will be working remotely. And that has huge implication. On the one hand, you save a lot in terms of office space. You can then give that money back in terms of higher staff compensation. The argument is it become a much more operationally resilient model because you're not tied into a particular office space. And it works. I think this episode shows that, you know, work don't only get done in the office environment, but it has huge implication for real estate. It has huge implication for how city develop going forward. Imagine now, because of convenience to work, most people will rent a small apartment closer to the workplace in city center. Going forward, if given a choice, you can work from anywhere in the world or anywhere in the country. You will rent a very nice place further away from city center, next to a lake or next to a golf course at probably the same or less rental compared to the apartment that you rent in the city center. So it has huge implication of how even city develop going forward. The sharing economy will be different given the need for safe distancing. Co-working space has been a trend, hot desking that has been a trend, will be impacted. You're not likely to want to do hot desking if you do not know who came before you, whether the person is healthy, etc., etc. The issue of ride sharing, DT, Uber, Lyft. Are you willing to jump into a car with somebody else that is alien to you? So all these issues will likely evolve. If I can have the next slide. So in terms of the impact, because of all those things that I mentioned prior to this, we are going from a very positive credit cycle to a negative credit cycle. A lot of VCs and PEs through this episode has suffered huge devaluation in terms of their portfolios, right? SoftBank yesterday, if you read the news article, was one of the casualties, right? So high valuation has been impacted in the fintech space. There's going to be renewed focus on profitability and path to profitability for fintechs instead of growth, right? So there's going to be a greater premium that's going to be placed on profitability rather than growth going forward. In the next 6 to 12 months, the fintech, especially the smaller ones with lack of funding, is going to be quite vulnerable, given that growth is going to be quite stagnant as the economy tries to pick up again. There's going to be uncertainty over things like valuation, next round of fundraising. For those that have deep enough pockets, cash management become key. How do you utilize your resources to get the most effective marketing, to gain traction quickly? How do you manage your staff? So there's a fair bit of viability issues, not only on fintech, but small and medium enterprises in general. OECD has a research that shows that more than 50% of small and medium enterprises will not survive in the next 6 to 12 months without financial assistance from government. And that's a critical issue because if you look at OECD country, about 2/3 of the employment of those countries are in the SME sector, and half of GDP are contributed by SME. So it is a key issue that we need to keep a close watch on the space. Can I move to the next slide? But over the longer term, the conditions are extremely favorable for anything digital, anything that's going to deal with fintech in general, right? So digital only will become the norm for financial services, accelerating a previous trend that we saw. We're going to see much increased momentum. Again, China is ahead of the curve compared to many other economies on that front. You're seeing a lot of trends that other countries will see. Right? There's going to be much greater competition between your incumbents and your challengers, be it in terms of fintech or big tech in general. And this episode of COVID show up a lot of shortcomings within the traditional financial institutions and financial services sector, right? So a lot of financial institutions proclaim that they are the best digital bank, they are the best digital format, they have digital platform, but that's not the case. So if you take, for example, what happened in the States, your paycheck protection program, where the government in the first instance put forth 350 billion to be given out or to be lent to companies with 500 employees or less, right? But because all these financial institutions, they can't quite do effective e-onboarding, right, remotely. They can't process data in a short period of time. They can't do that form of credit analytics. They are not geared in that manner, unlike many of the fintechs, right? So what they did is they rely on existing clients. They extend the loan to existing clients. But most of their existing clients are big boys. Some are listed companies that have access to the capital markets and credit markets. And when the government realized that there was a huge fiasco and all these listed companies are forced to then give back the money to the government or to the financial institutions for it to be lent to those really needy ones. And the government has to really top up again that coffer to be lent to much more. So you see all these episodes coming forth because whatever the proclamation is, there is shortcomings. The financial institutions have not really served the needs of the society in that sense. And financial institutions will turn to technology companies, technology providers, instead of relying on in-house solution because they need to accelerate much faster going forward. If I can move to the next slide. So this is by no means, and I welcome a discussion later. This is my take of the landscape. You may or may not agree with me. I think we welcome a debate on some of these matters. But for the winners going forward, there are a few, I think, that will emerge much stronger. If you're in the consumer SME lending space, you have access to deep capital. You can deliver capital to key segments of the economy quickly and well, and you can do credit analytics very well. You'll be much better off, right? Because there are real demand, real need in that space. So if you look at what's happening elsewhere in the world, Square, after they used to provide a lot of payment, they are payment providers to SME space. But once this hit, they acquire a US bank charter because they need access to funding. Same as what happened to Lending Club, right? They acquire Radius Bank because they need access to a different form of funding going forward. So we're going to see some of this trend. The key is access to funding going forward. InsurTech, you're going to see great development on that front, I think. Mortgage and life insurance digitization, trying to use technology to disrupt the role of intermediaries, where the roles have been traditional face-to-face. Right? Insurance is a product that's more often sold than bought. It's the agent that come to you and tell you how great this product is. You need to have this to protect your family, to protect your income going forward. So it's more often than not something that's pushed to you. Again, any technology that can disrupt that will see great usage going forward. Anything that deals with trading platform, given the volatility that you're going to see in the market over the course of next 12 months, is likely to benefit, right? Given how markets are performing. If I can move to the next slide. So things that capture flows, the fintech enablers, AI, IoT, software solutions will be in high demand. Things that relate to digital identity, digital authentication, given the increased need for safe digital ID, given the volume of business that need to be transacted online, will benefit. Bots for call centers, account opening, loan automation, all this will benefit. Given a negative credit cycle, things that relate to risk tech will benefit, right? Because banks, institutions will need much more expertise in terms of managing the risk area. Areas of RegTech, regulatory technology, will benefit. Regulators like myself used to be able to do on-site inspection, going down to the banks, going down to the intermediaries to do on-site inspection. Now, because of safe distancing, because of lockdown, we can't do that anymore. So things that can replace some of those work will come in very handy and very useful. If you look at the entire financial services architectural backbone, especially in Western economies, they are at least 30 years old, some of them, right? So things that can replace that architectural backbone using blockchain will see an increase in demand, a benefit. Anything that deals with in-country payment, given the fear that physical money can transmit the virus, will benefit. The other key area that we're watching with some interest is the area of CBDCs, central bank digital currencies. Right? So areas on that front, I do think will take on a new growth dimension going forward. So these are the likely winners. Let me move to the next slide, where you're going to see some pressure going forward. And this again doesn't apply to everybody. The challenger banks that have not demonstrated a path to profitability. They have extremely high valuation, high cash burn. Given the lower expected activity post-crisis, I think those will be impacted going forward. Already, we have seen some of the challenger banks, not all, players like Oak North in UK has done extremely well. They are in the SME financing space. But others, the CEOs have taken a huge pay cut. Senior staff have taken huge pay cut to try to conserve cash. Areas of robot advisory wealth management, given that clients are de-risking, given lower asset under management, their bottom line will be impacted. This will not be relevant for China because you don't allow for things like crowdfunding, peer-to-peer lending, but those will be impacted. If I can move to the next slide. In terms of payments, especially if you are in the business of cross-border payment, next 12 months will be tough, right? Because travel has been impacted, hospitality business, cross-border has been impacted. If you are in the business of remittance, given that there's going to be much less need for, in some economies, or migrant workers, remittance business is likely to going to be impacted quite a fair bit. And generally, given how the VCs have been impacted in terms of their investments, they are trying to replenish their capital. You'll see some pressure in terms of valuations, in terms of later stage round. If I can move on. So that is in a nutshell what I have to share on the FinTech, on the economic front. I would just like to share very briefly Abu Dhabi and Abu Dhabi Global Market before we move on to the discussion. Abu Dhabi is one of 7 emirates in United Arab Emirates. I think for friends in China, you might know Dubai much better because of the tourism sector and aviation sector. But Abu Dhabi is the largest emirate. It is the capital of UAE. Abu Dhabi accounts for more than 2/3 of GDP of UAE and 3/4 of the investable wealth. Right? We at Abu Dhabi Global Market, we are international financial center. We are a very young international financial center. We started operations about 5 years back, right? So 5 years ago, you wouldn't know of ADGM. But in 5 years, we managed to transform the landscape. We are the fastest growing asset management hub here, fastest growing real estate investment trust, and the most vibrant FinTech hub in this region. It didn't happen to be like that. When we first started, we have no track record to talk about. You have many other centers that have more than decades of head start before us, but we managed to transform that. So in the last 5 years, we have won 4 Financial Center of the Year award for the Middle East, North Africa region. Last year, we were awarded the Best International Financial Center for Europe, Middle East, and Africa region. On the FinTech front, I just wanted to touch on briefly. We realized very early on that there are pockets of the ecosystem that's not developed. For example, Middle East is a great place that you come to raise funds, but it's not a preferred listing destination for companies. It has 3 of the largest commercial aviation airlines in the world, but it's not a venue where people conduct aviation financing. So there are gaps within the ecosystem. And one of the gaps that we realized very early on is the need to embrace fintech, the need to bring about much greater financial inclusion, the need to really bring about much greater financial services to this region. Right? So on fintech front, we were the first to roll out a regulatory sandbox. By now, our regulatory sandbox is the second most active globally after the London sandbox. We are the first to introduce new concepts such as digital banking license. We have digital banks that are operational here. We're the first to introduce things like securities token offering, digital asset framework to regulate exchanges and to regulate offering. And our digital asset framework is very comprehensive, right? It's one of the most comprehensive in the world. So other than AML, KYC risk, we address custody risk, we address risk of investor protection, exchange operation, given that there are accusations that there are fake volumes on some of these exchanges, technology governance, and so on, right? So every time a coin or virtual asset is lost or stolen, impacts the credibility. So we address all these risks, and that has gotten the endorsement of institutional investors and global regulators. Global regulators are looking to our framework as guidance of what needs to be done. And without institutional investors in this space, you're going to see a lot of volatility because they form quite a big part of the volume in this space. So we are quite happy on that front. We continue to do a lot of experimentation cross-border with other regulators, including coming out with compliance tokens. So imagine a particular product, a token that can be offered in multiple jurisdictions at the same time and complying with rules and regulations of multiple jurisdictions, right? So those are the type of experimentation that we are doing. We are rolling out the world's first digital laboratory, and that is Regulatory Sandbox 2.0. What does that mean? That brings together the fintech players, the financial institutions into a marketplace. There's cloud hosted, there's a digital platform. It has data for testing. So we bring about all these players for experimentation, for proof of concept, for innovation, with regulators standing in between to provide guidance, to provide supervision. And VCs can invest in that space, right? So it's a dynamic space. I think the beauty of it is it allows financial institutions to procure products and services, to test products and services very quickly. And you know that financial institution, the procurement process is a huge pain for most fintechs. It's a long process, but through this, allow them to know what they really need to bring fintech in terms of their development quite early on as they work through their internal process. It's API enabled, which in this part of the world is a very important and critical component because the APIs here are not that great, right? So it is API enabled. So we are building that. It's going to be the world's first digital lab. And we're working with our friends from China on that front, from OneConnect, Zhejiang Tong. So we are glad to have all this innovation. And with that, let me hand it back to Dr. Chen.
Okay, so thank you very much, Richard Teng. Thank you for your in-depth perspective. Although we're facing a lot of problems, the whole world are facing the problems, but we are trying our best to tackle these problems and find new ways, find new opportunities for figure out it. And also fintech and big financial institutions plays a very important role, as you have mentioned, in this period of time. And next we'll have the discussion time. First we will turn to our panelists. We have Professor Ben Shenglin, who is the Dean of Zhejiang University International Business School. Prior to his academic career, he was the CEO of JP Morgan in China. And I will be very interested to know what kind of questions or what kind of point of view would Professor Ben Shenglin give to us. Okay, your turn.
Thank you, Hu Jie, and thank you, Richard. And first of all, a warm welcome to Zhejiang University. For those who don't know Zhejiang University, we're an older university in China. It's tomorrow, actually. We're going to celebrate 123rd anniversary. So making us one of the third oldest university in China. But the International Business School, what we call ZIBS, is a young institution, even younger than Richard. Than your institution, we're about 2 years old, okay? But we want to be, entrepreneur, we want to be innovative, we want to be globally oriented and future ready as well, okay? And Richard, your presentation, was very well structured in the sense that, you got the winners, you talk about some of those who are under pressure, and you also focused on the greater competition between some of the incumbents and the challengers, okay? In nutshell, my original question was about the asymmetric impact of the COVID-19 on the economy, and you seem to have already answered in that aspect. But I have one question though, is that on the geographical dimension, you are representing one of the largest, most important hubs in Middle East, which represents about 500 million people. And you also worked in Singapore, which probably, Paul, you can also address as well. So if there is a competition outside this COVID-19 in the field of FinTech, adoption, application, and acceleration, which regions and which countries and which cities may be, moving faster, forging ahead faster, and which regions may be losing or maybe under pressure in your term? Okay.
Oh, that's a tough question, Professor. My view is that China is up there, ahead of the game, is way up there. And the uniqueness of China, where you have really seen that it's almost a cashless society right now, right? With Alipay and WeChat Pay, you are so much more advanced compared to many other places. You can do much more experimentation. So it came as no surprise that China will be the first country to really push out central bank digital currency. Right? So on that front, China utilizes big data to great effect. When I visited Ping An, and I look at how they do insurance claims and assessment, because there's so much data available to them. That's something that's unique. So you are able to push through a lot more innovation, right? Of course, US has been a hotbed of innovation of FinTech on that front. But going forward with the increasing protectionist tendencies, I would say that, look, the biggest sort of weapon in the arsenal for US has been the H-1B visa, right? You're able to draw talent from all over the world. If you look at Silicon Valley, right? The best talents from the world, from China, from India, etc., are there. And that creates a vibrant hub that you have. Going forward, would that still be the case? I'm not quite sure, right? If you're not able to attract the world's talent, and many of these talent are going back home, be it in terms of China, be it in terms of India, given the opportunity in those space, I'm not quite sure it will still continue about that path. I won't rule US out, right? But again, it might, depending on the migrant policy on that front. India, I do think, is going to push ahead quite rapidly on that front. Yes, certain things that it needs to overcome domestically, but it's a huge marketplace. Another big market, I think, especially for deployment of innovation, will be Middle East, Africa region, given the need of the demographics, right? By the year 2050, this region will account for more than half of the world's population growth. So there's huge need for financial services, huge need for financial inclusion, huge need for FinTech. So we're going to see a lot of demand in that space. So just let me leave my comments on that, on some of my thoughts on that.
Thank you, Richard.
Okay, that's all for your question, Professor Ben. Okay, so thank you for Professor Ben's critical, or you can say a little bit difficult question, but still thank you for Richard Teng's very clear answer. And then we'll move to Paul Short. He is the professor of practice of Zhejiang University International Business School. So it's your turn to have a short dialogue with Richard Teng. Paul?
Yeah, Richard, one thing I was looking at recently with some clients in Asia is you have some very large corporates that have issued a lot of commercial paper, and of course, including some of the oil producers, like Pemex in Mexico has $110 billion in bonds outstanding, and oil prices are very low. And so we're seeing cracks occurring. And so I wonder if perhaps we're underestimating some of these emerging market countries where I note, for instance, the countries that have the greatest capacity for the downgrade of investment grade commercial paper into junk, fallen angels, would be countries like Mexico, Brazil. I think China is probably okay. Probably one or two countries in the Middle East, Turkey. To what extent could there start to be a cascading emerging market debt crisis with the COVID knock-on effects?
I don't think I will mention any countries per se, but by and large, I do think that we have underestimated the downside risk, not only in credit side, but if you look at equity side, if you look at the way capital markets have been performing, right? Given that the economic outlook is still uncertain at this point in time. But if you look at how the US market has performed over the last 2 months, right, is a bit mind-boggling, right? So I do think that investors by and large have not quite priced in fully the downside risk to this. I think that's one. Secondly, there's a need to continue to pursue especially among the institutional investors, to pursue yields, right? And given a prolonged low interest rate environment, they tend to take on more and more risks in pursuit of that yield, right? So is that right over the long term? My view is that only a few countries can continue to issue debt the way we see, right? US, China, Germany, Japan, right? These are some of the countries. But for other countries, you must be over the longer period of time, show that you can be fiscally responsible, you can balance your books, so to say. Otherwise, it's going to be quite a tough situation. And that's why I mentioned quite early on, countries will have to look at how do you increase that revenue through things like taxation.
Maybe I can pitch in here a little bit. I think even before the crisis, I think the sovereign debt, the total sovereign debt of the world was already very high compared even to the say global financial crisis about 10 years ago. So we were talking about like $70 trillion US. And on the corporate side as well, the leverage ratio was just historically high. So maybe thanks to the lower interest rate environment. But the other thing is that we probably should actually be differentiated between raising the funds domestically in local currency or in a foreign currency. And certainly, some of the smaller countries won't be able to raise funds offshore. But how about domestically, the local currency market? I think that probably is something that in Asia, for example, Richard, that in Asia, as ASEAN countries, they have been developing, the low currency market, especially after the Asia financial crisis. Yeah.
Absolutely.
Okay, so that's your question, Paul, and that's your additional question, additional things to details to explain, Dr. Ben Shenglin. And thank you for Richard Teng's answer, and it's turn for Dr. Chen Hongyi. It's your turn to raise question for him.
Okay, Richard, thank you very much for your wonderful presentation. And when we met in Cambridge 3 years ago, let you know, I was in charge for the Asia Pacific research. So we survey and we do a lot of the empirical study from across the region. And we also understand so many regulator and policymakers, they put a lot of effort to really bring the FinTech into the policy agenda. So I think that is very interesting. That in Abu Dhabi you are like almost from maybe like zero to build up as the international financial center. So I very much like to know from your perspective in the last 4 or 5 years when you working for Abu Dhabi Global Market. What do you think that will be most important factor to build a fintech ecosystem, considering like the factors such as talent and regulation, capital, transportation, and also what kind of jurisdiction they apply to, because obviously we also have like Astana International Finance Center. They are also focusing quite the same. So maybe, and a small additional question is like, what kind of position that Abu Dhabi would like to take in that sense?
I think it's a great question. I'm not quite sure we have enough time to tackle the whole spectrum of that. So just let me say a few things. I think the various factors that you mentioned just now are all important, right? So you need enabling, because financial services is one of the most heavily regulated sector within the economy, right? And most of the financial services regulator are trained in a certain way, right? I'm very glad that we managed to assemble a team that is not your traditional financial services regulator that don't wear the hat in such a manner. They enjoy working with the fintechs, and you're working with the best and brightest in the fintech world. That you know new business model. And the more we work with them, the more we understand their business model, we understand what sort of risk could be transmitted through the sector. And you need, as regulators, to have a certain level of humbleness to go down to say, look, can you teach me? And I'm not trained in that, as you can see at my age. By their definition, I probably am a tech dinosaur in many instances. But you need that humbleness to go down. You need to have an environment that can allow you to bring the best and brightest talent from all over the world. You need to have a vibrant ecosystem where you have tech investors, be it angel or VC funds that invest into all this. You need a marketplace, and you need financial institutions that can adopt all these fintechs innovation, right? And you need a marketplace for all this to be introduced. So it's a combination of many factors: capital, market, talent, regulations, enabling regulations that create a vibrant ecosystem. And I do think that by and large, if you look at our landscape in Middle East Africa region, Abu Dhabi Global Market is the most enabling in many of those aspects, in terms of allowing talent to come in freely. There's no personal taxation to talk about. So he's a huge attraction for most people. We have no restrictions on who comes in. As long as you're talent, we welcome you. You have in existence 2 of the largest sovereign wealth funds in the world, Abu Dhabi Investment Authority and Mubadala, managing northwards of $1 trillion. And they look at investment into this space quite keenly. We have many other institutional investors, VC like Plug and Play of the world that's based here to invest into those space. So we have a very enabling ecosystem. As a country, we may be small in terms of the size of population, but we adopt a hub strategy where you can access a much bigger, much wider Middle East Africa market. So it acts as an incubator, it acts as a transmitter into a much bigger market. So we play that critical role.
Richard, do you welcome, like a good business school from China to set up a campus there?
Absolutely. I want to mention that Abu Dhabi Global Market has an academy.
Oh, yeah.
We work with global service provider, knowledge provider. We recently signed an agreement with Cambridge University as well, to really bring up the level of knowledge expertise in the various areas that we need to prepare for a knowledge-based, a digital future. So we are very happy to collaborate on that front and discuss collaboration.
Great. Thank you, Richard.
Okay.
Can I ask a question to both, I think Paul and Richard, because I can't resist. This is a fantastic opportunity. Yeah.
Okay, go ahead.
Okay, you talk about asymmetric impact on the economy, the big tech companies are just almost like benefiting from the crisis. You know, if you look at Apple, you know, Amazon, Microsoft, market cap 1.3 trillion US dollars. That's a lot. But if you look at our so-called like traditional financial service companies, my ex-employee JP Morgan is less valuable than Visa or MasterCard, even though JP Morgan is the most valuable bank in the world right now. Citibank, HSBC, they are just really low in terms of valuation. So how low can it go? And for the technology companies, how high can it go? So this is a question for both of you, because Paul is as a fanatic about the technology adoption and valuation as well.
I think Paul should go first, given I've spoken a lot.
Yeah, so the 5 big tech companies now are 50% of the S&P 500. So we should be calling it the S&P 5, not the S&P 500. You know, Zoom that we're on right now has more market cap than all of the airline companies put together. You know, as an example, I think that seems wrong. I really worry about the banks because I think that we are going to have, I think we're going to have an emerging markets. I think the epicenter of the summer fall is going to be in Latin America. I think that we're going to have a Latin American debt crisis, and there's a, you know, the American banks are very, you know, tethered to Mexico and Latin America. And so we have to see what's going to happen there, because you're looking at, you know, $300 billion of as Richard mentioned, foreign currency debt that's been issued to Mexican, you know, entities. And then we have, you know, a lot of money that's been lent to Brazilian entities, Colombia, and other countries in South and Central America. So I think the banks are under pressure. I've been looking at banks for like 16 years. Pay attention to the bank stock prices. The bank stock prices tell us everything. And right now, they're a very good harbinger for the equity market. Right now, the bank stocks are just not performing. The banks are flat as a pancake and really are still on the lows. Except for last night, we had a bit of a rally. But the banks have been not buying the central bank intervention. And that's something that we need to pay attention to and worry about. The banks tell us a lot of information. They are the canary in the coal mine.
No, I totally agree. I totally agree with Paul. And maybe just to add another thing, you know, you can't argue against the market, right? But I do think that the market is getting ahead of itself in terms of the pricing of the big tech versus the traditional financial institutions. Because if you look at how the Western hemisphere, in terms of the different economy, the regulatory system is set up, it's not quite like what you see in the East or in China, where you allow Ali or WeChat to grow so big, right? There's too many regulatory barriers and hurdles that are set up, right? You can gain traction, but do they gain the same sort of traction that you see in China? Probably not, right? So are we overly optimistic in pricing in some of the premium and growth premium for some of this big tech to transform financial services in the West? I think it's a big question mark for me on that front.
Thank you.
Okay, thank you. It seems to be a very intense discussion. And we have a lot of audience want to raise question for you, Richard. And before we raise the audience question, I also have a question for you, because you mentioned about regulatory sandbox in your presentation before. And my question will be, the rapid growth of FinTech has posed challenges to regulators, and the Chinese regulators are also considering introducing new measures to normalize this industry. So there are also voices on regulation sandbox, which still gives it spaces to allow innovations. So where is the break-even point for the regulation? Is it
okay? But I think it's okay. But let me say this: I visited China quite often before COVID. I understand the industry. I wouldn't say well. It's the outsider's point of view. Unlike many other countries where a lot of FinTech players want to be regulated, right? the Chinese fintech don't want to be regulated. Don't come near me. I think that's one. And secondly, I think the regulators have taken a very enlightened and benign approach towards all this growth area and dimension to say that, look, we don't have a sandbox. The entire economy has become a sort of regulatory beachfront that you can do a lot of experimentation. We allow you to do so as long as it doesn't produce systemic risks. Right? So that's a very benign and enlightened approach. It allows for much more innovation to come into the marketplace. Is that the right way for most of the other economy? Yes and no. It depends on where you're situated, right? Because financial services, by and large, is a very, very heavily regulated industry. So, and regulators tend to be very cautious of any form of innovation, any form of risk that could be transmitted through the system. So most other regulators have not adopted the same approach. Singapore, of course, has a very, very good program in terms of embracing fintech, but not all the different jurisdictions have that.
Okay, thank you. And during our discussion and during the whole process, we see a lot of audience are raising their questions, but time is limited. So I will only read one question for you. And the audience said, okay, a lot of questions. Sorry, wait for some time. I will select one. I want to ask, how do the VCs to choose and invest capitals to these fintech companies, since there are many financial companies with fintech concept?
I'll let the rest of the panelists take that. Paul, you want to take that? Or
well, I think there's been a lot of you know, the old phrase, spray and pray. You know, I think there's been a lot of just spraying money around, and you know, I think fundamentally we have to look at the ones that have succeeded, and a lot of them have three characteristics. One, they have pedigree, right college, right family, right, you know, upbringing. You know, they have a really good, solid, you know, MIT, Harvard, Stanford. I'm afraid it's that's undeniable. Number two, look at Google. Google was a nothing site. It was a search engine that was the 14th largest. What was Google's difference? They got a VC funding from In-Q-Tel. In-Q-Tel is the hedge fund, the private equity fund for the CIA. You know, so look, companies that get money from the IFC, the World Bank arm. You know, the IFC is like a golden touch. You know, In-Q-Tel is a golden touch. You know, Temasek, GIC. So there are scrappy, you know, groups of people who create a lot, you know, fantastic, you know, things. You know, Jack Ma is one of them, but Jack Ma is very much the exception. And the rule is going to be, you know, Tsinghua, Harvard, MIT, Stanford, Yale, Berkeley, the usual suspects, Chicago. And there are going to be people who come from lesser institutions, but generally speaking, I think that tends to take your cue from that. I'm not being cynical. I'm just saying what seems to be the case.
And Paul, first of all, thank you for mentioning my alma mater as universities. But certainly, Zhejiang University probably belongs to that league as well in many ways. Coming up,
Zhejiang is for sure, yeah.
We are the most entrepreneurial university in China. 1 out of 20 of our graduates, they start their own business. So our alumni probably represents the highest amount of so-called market cap of listed companies in China because of that. And Jack Ma is a good friend of ours, you know. So for example, within Alibaba and Ant Financial, about 10% of the staff are from Zhejiang University. So that just tells you a little bit. But maybe I could also mention, you know, add a little bit for the VC perspective. When at, you know, say about 20 years ago, the US VCs, they came to China, they would bet on companies which have already, you know, they are doing something that the US was already doing. For example, PayPal was established in 1998 and Alipay 5 years later in China. Because of the scalability of Chinese market, so that was a good bet. It was easy, okay? Same to a certain extent today, as a lot of business models have been proven relevant and successful in China, in a market like China. The Chinese VCs now are looking at like countries like India, Indonesia, Nigeria, Africa, or probably in, say some larger countries in, say, Middle East, because they don't have to do the original innovation. They could just, copy the business model from China to a certain extent to their local market so that they can scale up quickly. And I think that's a good way for VC investors as well. Okay, so.
Okay, sorry. So we still have questions during the whole process because we have a lot of audience raising their questions when we answer that question. The next question will be, virtual banking seems like going to replace traditional banking in the near future. So what do you think about the security through this implementation? Who will answer that question? Richard?
Let me try to answer that.
Okay.
Indeed, anything virtual in terms of IT technology governance is a prerequisite. Is an important hygiene factor that needs to be addressed, be it in digital format for banks, digital format for capital markets, or digital format for insurance company, right? That is critical going forward, which is why even for our startups within our regulatory laboratory, I do think that many of them place emphasis on path to profitability, path to growth, which are extremely important. But there are some basic fundamental building blocks that you have to do well in order to scale up and be sustainable over time. If you don't do those well, you'll find that your growth will plateau. You run into problems later on. And one of the key challenges will be cyber risk, cybersecurity, technology risk. And another issue will be on KYC, AML risk, right? So you have to address some of those fundamental risks well in order to scale up subsequently.
Okay.
Well, but look,
so,
I mean, I'm very cynical about this because my ATM card at HSBC was breached. $5,000 was in Manila. I have had my Citibank card breached 3 times. I keep getting letters from Citibank saying, we're sorry, we're giving you a new card because the card was breached. PayPal has not had breaches. So I'm sorry, but we need to ask this question about commercial banks and the security risk of having a commercial bank account, not an account in a new, startup FinTech banks, because the track record is that the commercial banks themselves have appalling systems that are old, antiquated, based on copper. They're 30, 40, 50 years old. And, they are the ones that still, the narrative here is all wrong. And I think the commercial banks control part of the narrative. And so Alibaba doesn't have breaches, right? Tencent doesn't have breaches, right?
But the challenge is that you're still banking with the commercial bank as well.
I wish I wasn't. I can't get around it.
Yeah, precisely. Yeah.
I would
so
love to,
as a startup, you need to make sure that those things are done better. That's part of the value proposition.
Paul, you're way too rich. If you move to China, you can bank with WeBank or MyBank, okay? And there's so far no security breaches. And of course, in the US, you could do the Marcos, right? Under the whatever the Goldman thing. Okay, so.
Okay, thank you. Because time is limited, although we have a lot of questions for the audience to raise, but we still we have to end today's discussion. But before ending today's discussion, we will first thank for every including Richard Teng, the speaker, and every panelist today attending today's discussion, and welcome and thank you for your contribution to today's work. Thank you. And before ending, we will invite again Dr. Chen Hongyi to forecast next section of our section.
Okay, so thank you very much for Richard, Paul, and Ben, your wonderful input and valuable insight for making today's webinar so engaging. So I'm just a quick announcement for our next webinar. So I'm very much like to thank to everyone join us and following us on the internet. So please join us next Wednesday, 27th May at 2:30 Beijing time, which I think today we also have many audience from Abu Dhabi, so that will be 10:30 Abu Dhabi time. So we have pleasure to invite Mr. Adu Babu from PCCW Hong Kong. So he will present the topic evolving role of technology service in FinTech. So thank you very much for joining us today.
Okay, thank you.
Thank you.
That's all. Bye-bye.
Bye-bye.
Bye.
Thank you, Richard.
Thank you.